I'm going to just bring you a chart here. Now, this is just showing what's been happening in this part of the world, emerging markets,
sure,
and the pain that they're suffering. These are emerging markets index, MSCI emerging market index of stocks in the white, and we've seen the Bloomberg Barclays Global EM index of local currency bonds. Yeah. Both of them seeing money just flooding out right now. Yeah. Have we bottomed? That's the big question. Nobody knows the answer to that. But are you getting a sense that we're near to that bottom now?
Well, I ran some data yesterday, and China's down about 6% so far this year. Japan, the biggest constituent of APAC, a developed market, the biggest constituent, is down 3%. We had the kind of exogenous shock announced the day before yesterday that China's going to pump some more money into its economy, and the stocks have responded. I think going forward, then there are lots of endogenous things that Asian companies can do to improve the way that investors look at them. Things like dividends, things like corporate governance, things like share buybacks. All of these things have been tried and tested in the US, which is a bigger developed market. But China's economy is still growing at twice the rate of the US, and it's trading at a material discount to US equities. So I think Chinese companies, which is the biggest constituent of EM, plus Korean companies, second biggest, can actually do quite a lot themselves to reset the valuations.
Jim, just want to jump in there. We've got a milestone yuan reference being set against the dollar. 6.8040 is what we're getting today. Of course, yesterday's setting was already the weakest in about a year. We had offshore and onshore yuan really converging to trade both at the lowest levels that we've seen in over a year. 6.8040 again is what we got from that yuan daily fixing from the PBOC. Does this continue to suggest that China is pretty comfortable with a weaker currency, but also that if you take a look at, potentially these new spending measures that will support growth going into the second half of the year, that the fundamentals for the currency may not be quite so bad?
I think if you look at what China's doing, I think it's responding to Trump's measures on trade directly. And we see some parallels here with Japan in the 1980s with the Reagan administration. That culminated in the Plaza Accord in New York in 1985, where governments around the world, the G5, agreed to depreciate the US dollar. What is different this time is that we cannot have any multilateral decisions happening anymore because Trump is so unpredictable. That caused realist behaviour, that's international relations theory, and therefore countries are trying to protect their own interests. And therefore China, I think, is allowing its currency to depreciate because net exports is still quite a material proportion of GDP composition.
Yeah, it was interesting. We were talking to an analyst yesterday and saying the expectations when it comes to these trading relationships are so low at the moment because of all the rhetoric of the trade war that even if President Trump goes in and manages to kind of renegotiate some wins or could be perceived as wins, we're going to see another leg up when it comes to the stock markets. Jim, I just want to mention that weakening in the yuan fixing is another one-year low. 6.8040 is what we're seeing. Do you think, given that we're, 2% away from all-time highs in the US, that there's really any, justification to another leg higher?
I think, go back into what you were saying, there is often a disconnect between what is happening in the real economy and what is happening in the stock market. Often the stock market, the index is composed of industries which are very different from the wider economy, and we see that here in Asia. So from the perspective of China, Korea, Japan, Taiwan, very exposed to the US in terms of its trading links. However, I think if you look at Southeast Asia, you've got a lot of countries there which, again, are quite insulated from what's going on in the US. So I think to say that the stock market should have a material decline because of what's going on in the wider economy is somewhat a kind of wrong implication in our view.